Welcome to this series on the basics of stock markets, and in this I'll be walking you through the very basics of the stock markets as the title suggests, and I'll also be giving you a couple of tips here and there, just trying to help you go in the right direction, because the number one problem that I've seen people face is that they know that, hey, stock markets are fine, it's not really that bad, but they don't know where to start. And as someone who's been through that before, I thought I'd share my experience with you, and I'd share my views on how you can start and how you can better begin your trading or investing journey. So without further ado, I'll minimize my face because, let's be honest, that is not that important here, and it is, I think that's the right size, and we'll move to the presentation. So now, the way I like to put stock markets is that it is the fanciest vegetable market that you will see, and you'll see why in a bit. But yeah, this is Financial Markets 101. This is going to be around a 3-part series if I can get everything right. So it's broken up into smaller chunks that are slightly more palatable, let's just say. But what are the stock markets? And there are some very common misconceptions that people have about the market. To start with, it is definitely not gambling. This is possibly the most common myth that people have about the markets. It's not gambling, trust me. People liken it to poker a lot. People also liken it to chess a lot. But again, it's very different. Stock markets, investing is a different ball game. Trading is a different ball game. Option spreads are different. Again, it's very different. The next myth that a lot of people have, or rather misconception that a lot of people have, is that if you invest or if you trade, you'll lose all of your money. And there's no easy way to put it. There are many people who've lost their money for real. Like, it is not a joke. Many people have become on the verge of being homeless because of their poor financial decisions in the markets and because they invested wrongly. But if you do it right, there's a very negligible chance that something like that would happen, especially if you do it right. So that is definitely not the case. If anything, you'll hopefully make money. And the third misconception is that it's a rich person's lottery. Like, rich people, they've got access to certain things that us retailers don't. And that's why stock markets are, a great way for rich people to make money. But as far as we are concerned, the average people, retailers, as we are known, it is not really a viable way. But that isn't true either. It is true that not many people, not many retailers make money. That is true. But at the same time, it's not that, hey, if you don't have like bundles of cash, you can't make it. That's definitely not the case. You can get started with as little as a few thousand rupees. Now, the next thing is that it is only for people who look at weird charts 24/7. And that's not the case, because when I started my journey in the financial markets, I was really not into charts a lot, and it became very boring. So when I started, I did not look at a lot of them, possibly 30 to 50 a day max. And it sort of happened over time that it earlier took me a couple of hours to go through 50, but then it just took me a few minutes. So we sort of developed that habit. Plus, I was not looking at them 24/7. I was just looking them around every night or so, and one day on the weekend. So it's definitely manageable. It's not a problem. And there's a lot more than stock markets when you talk about the financial markets that we'll get to. Now, today's agenda, or rather the agenda of this series, is that I want to make sure that everyone understands that the financial markets are one of the most interesting and high potential industries for people, and learning about it and actually starting now, taking action, not just looking at this. Taking action will kickstart your career in a way which will make your future self thank you. Now, this might seem like a very long and very bold statement, especially if you're not into finance, but trust me, this is possible. People are making great passive income sources. People are making great cushions for them, even if they are not full-time market professionals. So let me just say that this is not meant for people who want to get into stock markets full time. It's also meant for people who just want to learn about a potential second passive income source. And my agenda, my mission here today is to make you believe that that is possible. Of course, there are complexities. Nothing is ever going to come that easy. But my job here today is to make you at least believe that it is definitely a possibility and hopefully help you understand what exactly happens. So the first series, first thing is that I want to talk about more about the markets, what the basic principle of the markets are, and I've titled this "Stock Markets Aren't Gambling," and you will see why in a bit. The second part is that how you can gain the confidence that's required, just a little bit about the certain tools, some basic intricacies about the markets, candles, charts, trends, the likes. And the third part is how you can arrange funds, choose a broker, a decent broker, and get started. Actually take action on your idea of hopefully making a good passive income source or just learning something new. So this is going to be the plan for this session. It says this session because this was supposed to be, or rather this was from a couple of sessions that I'd taken earlier, where I thought I'd just condense it into a YouTube video because it's more information for everyone. So here we go. Stock markets are not gambling. This is very important to understand. Mindset is extremely important in the markets, and if you go in with that negative mindset, you are off to a disadvantage. Now, I said earlier that stock markets are the fanciest vegetable market you can think of, and the reason for this is, you can see what I've written here. People buy and sell relatively standardized items in the vegetable market. Whether you buy aloo, tomato, pyaz, it's all going to be the same, relatively speaking. And in the financial markets also, if you're buying one share of Tata, one share of Reliance, it's all going to be relatively the same. It's a standardized items. They can be customized, but for the most part, they are standardized. The second thing, I'm not going to narrate everything, but you can see that there are a lot of options for buyers and sellers, and you've got a plethora of choices where to buy from, which price can you buy at, which price you want to buy at, and which price you want to sell at, and so on. That's again the same, and the prices are determined by demand and supply, news-based items, macro factors, and fundamental factors. For instance, back when there was some problem, I think tomatoes or onions were facing a crisis a couple of months ago. At that time, the prices had surged above 100 rupees per kg. That's a fundamental macro factor, news-based factor, and that is also something which affects the markets. For instance, when Infosys's whistleblower news came out, Infosys saw a massive fall, and that's just how these things work. And finally, it's very important, don't get intimidated by some of the things that I'll be talking about. It's not difficult, it is just new. Many people, when they come across finance, when they come across stock markets or anything else that is new to them, whether it's coding or anything else, pretty much, they feel that it's very difficult, and they wonder at, wow man, this guy is the guy on YouTube, or the guy that's helping them learn, wow, he must be a damn genius because he knows this. That's not the case, because all of this is new to you, which is why it seems odd. It's not difficult at all. This is extremely simple, trust me. Now, I've noticed something, and that is that there have been people who've had zero prior experience, who've made it. There are people who've got dozens of failures in the past, and they've had great success, and there's no other way to put it. So the thing is, I was hesitant about the markets as well when I first started, but now, as someone who's been in here for the better part of around 1.5 years full time, and a little bit more when I was first introduced to the markets, I can safely say that it's not it's not intimidating, it's not gambling at all. And the thing is, when the probability of success is greater than the probability of failure, or when at least the probabilities are defined or can be defined, or you have some sort of control over the probabilities, it can never be classified as gambling, because you know you have control over it. You aren't giving up control to someone else or some other force. So the first thing that I'd like to start with is the power of compounding, and you might have heard of this quite a lot. It's a fairly common saying. The power of compounding is possibly the eighth great wonder of the world. If you look here, this is a website that I found. You can check it out. Now you can see at the right here, this is some image that I borrowed from some website. Due credit to them. If you Google it, you'll find out. You can see, you can pause the video, you can go through it. Essentially what it means is that the quicker you start, the better off it's going to be for you. Even if you start with 2,000 rupees now versus a bit more later, or a bit longer later, you're going to be better off just doing it now, because that's just how compounding works. And the table to the right, if you look at the numbers, it talks about 8% per annum, and you can do much better. So what it says here is that if you were to invest 2,000 rupees at age 19 to age 26, versus if you were to invest 2,000 rupees from age 27 to age 58, you would still be better off investing the original, for those 7 or so years, because your investment would be, worth 16 fold of what it was earlier. So if you would have put in, 16,000 versus 64,000 in this case, it would be worth 2.5 lakh or 250k. Here it would just be worth around 226k. So you can see how much it's grown. And again, this is the power of compounding. You can check out, there are various videos on it. Investopedia is a great source. Now, that's all good. But how are the stock markets not gambling? And this is where it can really get very interesting, because there are various ways where you can try and understand what may happen with a certain stock. For instance, there are indicators which give you hints of where the market could potentially be headed, or where many people think it's headed, or at least how it is placed right now. You've got fundamentals of companies like, a health report, like we go to a certain medical test. Let's say they put the syringe, they give us our blood report. Similarly, financial reports of companies are like a health report for companies. So it's December now, so we'll probably get the Q3 results of companies will probably start coming in. So we'll get the health report of those companies very soon, and using that we'll be able to see that, hey, which company is doing good, which company is not doing so good, and so on. Then we've got market psychology, which is insanely effective. Now, some examples are how tips work. You must have gotten those messages that, hey, buy XYZ at so and so price, target so and so, SL so and so. How all those things work, and it's an entire weird sort of science behind it. It's an entire almost cartelization kind of thing that happens, and all of that just means that it is there's a larger force that's controlling it. It is not gambling, because if you understand that, you're already one step ahead of the curve. Market discounting, again, there's just a lot of things that influence stock market pricing that if you understand, you're already better off than the majority of the people. News, very self-explanatory, and the different financial markets. So these are a few different financial markets. You can take a look at them. There's nothing really to be said here. If I talk about all these, it'll just be like a boring finance lecture, so I'll skip these. If you want, you can skip, you can pause the video, you can check it out on Investopedia, and I think it'll all be good. And here are the basics. A security is an asset, it's a stock, commodity, or any other asset. Again, these are some basic terminologies, let me be clear. IPO, we all know what an IPO is. FPO is a follow-on public offer. It's like an IPO, but more shares are floated. Corporate actions are any splits, mergers, bonuses, rights issues, dividends, all sorts of things. Corporate actions are typically announced in board meetings or special AGMs and such. Bid is an offer made by an investor. Ask is the price a seller is willing to accept. For instance, bid is the price you want to buy at, ask is the price the seller is asking for it. Tick size is the minimum gap between two consecutive prices. So let's say that I'm trading Nifty, which is the broad market index. The tick size of Nifty is different. It goes in like paise. The tick size 5 paise. And the tick size for something else like let's say a small cap stock would be different. It might trade in 1 paise. So it depends. Tick size. Again, these are all rather theoretical topics, but they are needed for you to get that stronger base. So the next one is lot size. This is the minimum number of shares that can be bought in one transaction. This is mainly there for futures and options, which we'll come to later. It's a bit more advanced. Volumes are the number of contracts that are traded in a given period of time. You might have seen this being thrown around a lot, that hey, volumes are massive. Long, buying a certain security. Short, selling a security first and buying it back later. These two are extremely important terms that you need to keep in mind. And again, it becomes second nature. Long is basically when you buy something. Short is basically when you sell something without owning it first and then you buy it back later. We'll get to when these are used and why these are used in a bit. Square off is when you enter into an opposite position. For instance, if you are long something, if you've bought something, squaring it off means that you take an opposite position. Essentially, you nullify both positions. When you were long, you sell that position. You're squaring it off. You've got no position left. For instance, another example. Let's say you want to buy something. You've bought something. And then you want to sort of exit that position. So you square it off. That's the word that's used. And forwards are customized contracts to buy and sell an asset at a specified price on a future date. Again, very important. And futures are forwards that are traded on an exchange. Very simple. We've got something else here, options. Options are the right to buy or the right to sell an underlying security. So we'll get to these things, at least the last 3 or 4 points a bit later. This one will mainly talk about the first few because though they are more relevant for beginners. Now, this is what we'll be talking about in the second episode of this series. So see you in the next.